Well, thank you guys again for coming out to the small business session on law and taxation, which is going to be great for us because we have actually simply just had some similar questions from many of our clients on their business formation. And it's also going to be recorded and shared with our other incubators who actually deal with business startups. The difference with the plan room as compared to other incubators within the city, we consider ourselves an accelerator and not an incubator because we typically deal with existing businesses and only existing businesses to help them scale up and land on large projects. We partner with our other incubators to help individuals who are looking to start up with construction, to help them to start up and then send them back to us for scale up. And this is going to be great. We're working with many of our clients that started their companies with not a lot of advice, just on the whim. And so a lot of the questions, even when we were sitting with a client yesterday, the question was, she's like an escort. And she was like, and she started her company back in 2009. It's like, should this really be the formation of my company that I should have, or should I be an LLC, or and so that's a question that we need to have good advice to give our clients to make sure that they're successful in sustaining their business and actually growing their business as well. And so we're so thankful for Frost Brown Todd and Metco Loans for leading this effort to have the session with us, and I am going to pass it over to Ms. Carr, and we'll begin. I'm going to share screen. Close edges. Thank you.
Wonderful. Hi, everyone. As Donovan said, I'm Nicole Carr, and I'm with Frost Brown Todd, who is my partner, Patrick Thomas, is with the tax group, and I'm with the business combinations and capital transactions group, which does primarily corporate work. And I'm here to talk to you guys about business formation. Some of this you all may already know. Someone said, one must focus a little bit more on accelerators, but we're going to start with the basics and just give kind of the background of why you want to choose certain entities over another, why you want to incorporate it all, and just give some of the primary considerations for those decisions. Go to the overview slide. So this is just a brief overview of some of the common common entity types. So the first entity, which is the default, if you don't take any action at all, if you just go out and say start a lemonade stand, and you're going to be a sole proprietorship / partnership. If you don't file anything with the government, you're just operating a business. If you, for multiple reasons, which we'll talk about in a second, we do not recommend that structure. It opens you up to liability, and there's some other issues that go along with it. So the two most common formal structures are limited liability company and corporation. Both of these are created and governed by state law. Go to the next slide. So the key factors with determining whether an LLC or a corporation is best for you are liability protection, tax treatment, formalities, management, and funding options. And so these are kind of what we're going to walk through to help make that decision. If you've already made it, maybe you want to switch. If you haven't made it at all, maybe, you need to figure out which one's best for you. So liability is the primary factor that causes corporations to, the motivating factor behind actually incorporating at all. So going from a sole proprietorship or a partnership, if you have more than one person, to a formal entity is because of liability. So say, for example, you are painting someone's house and you knock a painting off of their wall, then you could potentially be personally liable for that if you do not take any action, if you are just a sole proprietor. And so what having a formal entity does is it gives you a liability cap. And so only the assets that you've actually put into the business are exposed to creditors, assuming that, as we'll discuss in the next slide, you take some of the actions that you need to keep that liability shield in place. So the issue that commonly comes up with these kind of small entities that move from sole proprietorships to LLCs or corporations. So say you got your lemonade stand, you put your liability shield in place, you actually incorporated. That is not the end of the road. You still do have to take certain actions to keep that liability shield and to keep your assets protected. So both types of entities face the risk of veil piercing. which occurs when a court rules that the business entity does not exist in practice, and then you can be personally liable for the debts. So this happens, if, well, we'll discuss it on the next slide. So the solution to, reduce the risk of veil piercing and keep your assets, your personal assets protected, are to avoid undercapitalization is the most important thing. So you need to keep enough big money in the business so you can run the day-to-day operations. So that means that, you actually have a bank account, a separate bank account for the company. You have put money in there, whether it's your money, whether it's, partners' money, as we'll discuss later. Partners have, an actual business account with funds that you're using. You have to understand and observe formalities. So once again, the separate business and personal assets, that's one of the most important things. So the main factor that leads courts to say you are not actually an entity. This is just you running this business yourself. You're not treating it as a separate entity. This is just you going out and starting something, is if you are taking your assets and just paying for business expenses. So you're taking your personal PNC account, taking money out and paying for paint or paying for, lemons, then you would,
I think you might have been muted there.
okay.
But my question, or well, not really a question, more of a comment.
Yeah, absolutely.
Sorry.
Please do. No, please, anytime.
But the formalities are also really important in the tax context too. So I deal quite a lot with businesses who have, bring in a bank account and it's a business bank account, but it's chock full of personal expenses, right? Or vice versa. And it's really hard for your accountant or, TurboTax, if you're doing it that way, to really accurately see what you're making in terms of a profit and properly report your taxes. Also can get on the IRS's radar. And that's bad for a whole, host of reasons, but just another reason that you really want to keep those things separated as much as you can.
Thank you. So.
Yeah.
That's all.
I think you're clicking on the Zoom. So you may need to go back to the PowerPoint. Just click the icon down there. Yeah, there you go.
I can keep going and then we can distribute,
Okay.
the PowerPoint to anybody who wants to
Yeah.
kind of follow along and match up the presentation with the PowerPoint itself. If that works for you guys. Let's do it.
Okay, we'll just go down it.
Yeah, no worries. Well, I'll just power through, and like I said, we can just distribute the PowerPoint to anybody who wants to kind of match it up and see what we talked about.
Yes.
So as far as formation, now that we've kind of gone through the bail piercing risk and why you would want to form an entity, we're going to go through just basic steps on how you actually form an entity. It's boring, but it's important. So to form an LLC in Kentucky, which is what we generally recommend. We would generally recommend if you go the LLC route that you don't form the LLC in Delaware, you form it in Kentucky, because an LLC is easier to run, as we'll get into in the pros and cons. And so Kentucky kind of cuts down on the filing costs. It's just the easiest entity, and it's even easier if it's in the state that you're located in. Kentucky's pretty straightforward. So the first step is to choose a name, which I know sounds obvious, but a lot of times it's one of the hardest steps to get over. People have a hard time nailing down what they actually want to be called, how they want to represent themselves. And you need to check to make sure that name is available, which you can do on the Kentucky Secretary of State's website, just on their business search, which we can go into later if anybody wants to hear more about that. And then you file articles of organization with the Kentucky Secretary of State. It's a simple form. Once again, we can help out with anybody who needs that formed. Our summer associates prepared some forms for that, as well as the operating agreement. So the third step is appoint a registered agent in Kentucky. A lot of times people just appoint themselves. You can appoint, there's businesses out there that will help you, that you can appoint them and they'll get all the mail from the Secretary of State, any annual report stuff, reminders, things like that. Or if somebody sues you, then the registered agent is the one who will actually get that lawsuit notification. So that's very important. But once again, it can just be yourself. And then prepare an operating agreement. As we discussed, you have some forms for that, and we can help you guys out if you need some help. And that is the document that will actually set out all of the, how your business is going to be governed. If you're going to be a sole member, if you're going to be a multi-member, if you're going to be managed by the members or managed by managers, there's a few different things that will, how you are actually going to run your business going forward, and the rules that apply to you will be all set out in that operating agreement. Sometimes people don't adopt our operating agreement, and that is a big mistake, because if anything comes up later, it's very important. It's also one of those formalities that helps to kind of keep you in line and keep that liability shield in place. So you also need to apply for an EIN number and register with the Kentucky Department of Revenue. We have some employee benefits or some employee labor and employment attorneys that can help you out with that if you need some help with some of our paralegals. But that's very important, and you definitely want to make sure that you have that stuff in place. It's one of those things that some people don't realize they have to do, or they forget, and then opens them up later to a lot of issues. So the next option is forming a Delaware corporation. So if you do want to go the corporation route, for reasons we'll get into once again a little bit later, we recommend incorporating in Delaware. Once again, that only makes sense if you are operating at a certain level, if you want to bring on investors, but it just makes more sense. It helps out with those considerations if you are actually located in Delaware. And so in Delaware, it's kind of a similar process. You need to choose a name, file articles of incorporation, appoint a registered agent. And obviously, if you are not located in Delaware, then you would need to go through one of those services and appoint someone physically located in Delaware to receive mail and receive, any filings in Delaware. You also need to set up a corporate record book, which is something that you don't have to do if you're an LLC. There's a few more formalities if you're a corporation. You have their bylaws, which is the corporation equivalent of your operating agreement. So very similar, sets out how you're actually going to run your business, sets out distributions, sets out how the money's going to flow, sets out how everything's going to be, allocated, sets out your tax information, and then you need to appoint directors. So that's another difference between LLCs and corporations is there is a minimum number of directors required. So you can, with an LLC, you can just have your own, be one person running your business. With a corporation, you actually have to have multiple directors. You have to hold your first director meeting and issue stock, file annual reports, and pay franchise tax. So annual reports are something that you also do have to file as a Kentucky LLC, but it's a very, very straightforward form, and it's much simpler than the Delaware filing requirements. So the reason that we would suggest that you incorporate in Delaware, even though it does have higher filing fees in Kentucky, once again, if you're going to be an LLC, then we'd still recommend you do that in Kentucky, is there are more tax benefits. So there's no corporate personal income tax if there's no business actually transacted in Delaware. There's also a pretty low franchise tax for small businesses. So, it's kind of a trade-off as far as you have to do more formalities. You do have like a franchise tax if you don't in Kentucky with an LLC, but at the same time, you have a little bit more flexible business law, and investors are much more familiar with the laws in Delaware. And so a lot of times they will prefer to invest in an entity that is a Delaware corporation instead of a Kentucky LLC. So if you're looking to bring on like large angel investors, they may be a little bit more comfortable if you're looking at Delaware. So it really depends on what avenue you want to take. If you're really interested in like high growth, or if you're just kind of interested in running your business as a family business to meet your needs and not as like to become the next Elon Musk, then those are kind of the trade-offs there. So the next section is on taxation. So I'm going to pass that over to my colleague.
Okay, and I'm going to try to yeah. Okay. So first, I just want to talk about, like Nicole talked about, the defaults. What happens if you don't do anything? Right? What's the status? And as Nicole said, if it's just you running your own thing, running your own business, it's going to be treated as what's called a sole proprietorship. And any money you get out of that just goes on your individual income tax return and is subject to your individual income tax rates. Some people do have a misconception that, well, if I get paid in cash, I don't have to pay income tax on it. Or if I get paid under a certain amount of money, I don't have to pay income tax on it. No, so the federal tax code says you have to pay tax on all net income, net of your expenses from whatever source, whether it's cash or check or credit card or what have you. You also have to pay what's called a self-employment tax on that. And that's what often gets a lot of smaller business owners is they don't realize, in addition to the individual income taxes, there's a 15.3% self-employment tax that you've got to pay as well. And so that's something that you really have to plan for. Whether you're a LLC, corporation, whatever, this is just what happens if you don't do anything. And of course, if you got someone else involved in your business, well, then you're a partnership as a matter of law, which is kind of taxed similarly to what we'll talk about for LLCs. But it is complicated, and you can throw yourself into kind of a complicated tax situation by going into business with someone and not following these formalities that Nicole just talked about. I'm dealing with a client right now who really ran a partnership for 10 years, but they just treated it as if they both had a sole proprietorship. And we're going to have to go back all those 10 years and deal with that. And that's a lot of money for them to pay us, but it's a lot of hassle too, right? So you definitely want to think about these things ahead of time. All right, so Nicole first talked about the LLC, so limited liability company. And LLCs are these like really flexible entities. You can do kind of not whatever you want, but you can do a lot of things with them. But there are some default rules for how they're treated. So let's say, I'm going to go into business for myself, just myself. And I decide to open, Patrick Thomas's, what would I like to
Depending on what the
Bakery. No, I like to bake. So my bakery. I own the bakery. It's only me, right? And so I got my LLC so that if I burn someone, with my oven, I don't lose my house. But how am I going to be taxed? I'm essentially just going to be taxed because I'm the only owner, as I just said, for that sole proprietorship. The LLC becomes what's called a disregarded entity. So the IRS kind of looks through it, says, it's just you. So we're going to treat you exactly like a sole proprietorship. Oh, we got the slides back. Very good. So we are on the next slide if we want to go to that, or if that's possible. Awesome. So and I was kind of jumping around here, but that's how it would work if it's just me. Now, if there are two or more owners, then it's something different. By default, it's going to be taxed as a partnership. So basically, you take the business's income, the business's expenses, figure out what those are at the business level, and then split them up, right, among each partner depending on their share of the organization, which is generally kind of equal, right? So 3 partners, a third each, and that's going to be reported just as a partnership. You're also going to have to pay some self-employment tax on that income, but that's how that works by default.
Patrick, how does that work exactly? Like as far as, so you're filing your taxes for the year.
Mhm.
So if it's a partnership, do you get a separate form or do you just put it on your normal tax form?
Yeah.
Or you go to the nitty-gritty?
Good question. So if we got a sole proprietorship or a disregarded LLC, we're going to put it on the Schedule C of the Form 1040. And if we have a partnership or an LLC that has multiple members, we're going to put it on Schedule E, income from partnerships and also rental properties. So that I don't know why it's one form for both, but it is. So that's how it's going to appear.
So you just put that income on your normal tax return in that spot and you're good to go? Is that?
Well, depends on how you define good to go.
Okay, yeah.
But yes, in this context, good to go. Now, if you're an LLC though, with multiple members, importantly, the entity also has to file a tax return. Now, they don't pay tax on that return, right? That's what this concept called pass-through taxation is all about. The income and the expenses pass through the organization and go straight to the owners, right? But the organization still got to file a return so the IRS knows, okay, here's what the organization made as a whole, here's their expenses as a whole. And then the organization issues what are called Schedules K1 to the owners of the company. That reports out your individual share, and that's what you put on that Schedule E of your individual tax.
So as far as like your tax bracket, say that you have a job, normal 9 to 5, and you have a separate LLC that you're running. So you would just add those together, and that would put you in your tax bracket.
You just add those together. Yep, you get your
$1 is treated as $1 the same way as if you got it from your normal job.
Exactly, or a loss if you make a loss from the organization.
Right.
That can, in certain circumstances, and this is where people can get into trouble, take away from your other income.
Okay.
Yeah. Didn't know I'd get all these questions.
Sorry.
Now, back to that flexibility idea of the LLC. An LLC can elect to be taxed as a corporation. There are very esoteric reasons why you might do that. I'm not going to get into them, but just know it is this very flexible entity. I'm going to move on to the C corporation. Why do we call it a C corporation? Because tax nerds named it. The rules are located in subchapter C of the Internal Revenue Code. Yeah. These are your sort of ordinary run-of-the-mill corporations that have existed since the early 1900s. So corporations are taxed themselves, unlike the LLC. The income is not passed through. So you add up all your income and expenses, you got a net profit. Well, the corporation has to not only file a return, but also pay tax to the IRS on that income, right? And then if you as an owner get out any money from the corporation as a distribution, you're going to pay tax on that as well at the individual level. You can also, of course, receive a salary as an employee of the corporation. So that's going to be taxed a little bit differently if you're receiving compensation income. And as we'll talk about here in a second, C corporations can elect to be taxed either as a C corporation if you do nothing, that's what you are, or as what's called an S corporation. You want any of the summer associates, can you tell me why they are called S corporations? No. Well, come on, I gave you a big hint.
I'm guessing it's subchapter S.
It is subchapter S. Good job, Abby. 10 points to Abby. And we'll talk about what an S corporation means. The one thing I would say about the C corporation from a tax perspective is that if you're a profitable entity, okay, unlike LLCs and unlike S corporations, you can hold on to the earnings you've made in the corporation and not distribute it to yourself. It's not pay tax at the individual level. And that can be beneficial if you want to reinvest the money that you've made in profits into the corporation in the future, because then you don't have to pay tax on it at the individual level. In contrast, for LLCs and S corporations, if you've made some good profit there, no matter what you do, you're going to get taxed at the individual level, right? Because it just passes through you. So that can be one, planning point. Of course, everyone wants to make a profit, right? But hard to predict when exactly we will do that.
When you say totals or earnings, what does that mean?
Yeah. So like, let's say that corporation, my bakery has made a $20,000 profit in the last year. Okay. So if I'm a LLC or an S corporation, I'm going to pay tax at my individual rate on that income, period. But for a C corporation, okay, I'm going to pay tax on that at the C corporation level, but I don't have to distribute it as an individual. I can reinvest it in the company, and I don't have to pay tax on the income at the individual level. And that goes the same too if there's many shareholders of the company too, many owners of the company. The owners don't have to pay that income.
How do those tax rates compare? Corporate tax rate versus individual tax rate?
Great question. So this changed with the so-called Tax Cuts and Jobs Act in 2018. But that generally lowered the corporate tax rate below, certainly below the top marginal rates, which I'm nowhere even close to that, right? So really for most folks, they're kind of going to be equivalent. They're going to be near each other.
But you are taxed twice.
You
Which is
can be, depending on exactly what you do. You can be taxed twice.
So would you say that if you're going to set up your entity as a corporation, would you say that you definitely need to get an accountant? Would you say that's
Yes.
necessary if you're an LLC?
Absolutely.
Okay, so once you move,
I would say that you want an accountant if you have a business, period.
right,
Period.
I would agree
I
with
mean,
that. But we do occasionally see some LLCs, they just can't afford to and just starting out, they don't have an accountant.
Yeah.
Once again, it's not recommended, but once you get to the corporation level, it becomes a little bit more complicated. It's kind of a necessity. It's what we've seen from our side at least.
Absolutely, I would agree with that. It can be,
Unless you majored in accounting.
Yeah.
I believe it's more like a business growth level.
Mhm.
I think if an LLC is more operating as a mom and pop, or
Right.
you could probably operate without an accounting, but if you really kind of business,
Yes,
you're going to essentially use the accounting definitely, it's going to go up others capital.
absolutely.
That's going to be essential.
Yeah. Yes, but as soon as you hit that, if you you choose corporation, it does get a little bit dicey, so you can't really operate at that lower level.
Yeah.
From what we've seen at least.
If you're investing in your own company, say a LLC, instead of borrowing money from credit union or whatever, to fund your working capital, can the money you invest, your personal money you invest in, does that lower your tax rate when you file your tax?
If you're investing money into your LLC, generally not, no. You've got to be spending, the LLC needs to be spending money to lower your net income. Yeah. So then finally, the S corporation or small business corporation, the IRS calls it. Really, this is analogous to the LLC discussion we just talked about, or partnership discussion. It's a pass-through taxation. There are some extra requirements for who can qualify for an S corporation. And of course, like Nicole mentioned, versus an LLC, there are more formalities you have to care about because it's a corporation. It is a corporation. And so you've got to do all those things that corporations do. It's just taxed like an LLC. And I'll say the one thing that historically people have used the S corporation structure for is to basically have the S corporation employ you as the employee of the corporation, pay you a salary, and then you pay your income taxes and Social Security and Medicare taxes on that salary income. And then if you're able to generate a profit, you don't have to pay those Social Security, Medicare taxes on that portion of the income. So that's historically, I think, why a lot of accountants will often recommend an S corporation, because they're very familiar with that structure. Though that the tax law changes that I mentioned just earlier have made that, I would say, have made people start to favor C corporations more, frankly, over the past like 3-4 years than historically had been the case at varying levels of the income spectrum. So just something to keep an eye on, see what Congress continues to do to tinker with the tax code. And then just finally, some takeaways, we've already talked about it, but consulting with someone ahead of time is just, I can't recommend it enough. Even if you're just starting out, I think it's really important to talk to someone who has who has used an accounting system before, knows how to set it up. You know, it's not enough to have QuickBooks. It's not enough to have QuickBooks. You have to know how to use it, right? You have to know how to use it. You have to categorize things right, because it can otherwise turn into this sort of garbage in, garbage out, spreadsheet that you get at the end of the year that's not really useful when you're filing your taxes or otherwise, or for other purposes.
I'll say the same thing goes for entity formation. We see a lot of companies that come in and they end up having to spend, quite a bit more to fix any mistakes that they made in the initial stages than they would have if you set it up right from the beginning.
Yeah, I know, like, accountants and lawyers are expensive. Right? Absolutely. So, I would, one, look into community resources that we have to help folks who maybe don't have the working capital to do that right now. Just get some basic advice like that. But also, if you do have some, it's a worthwhile investment. And I'm not just saying that because I have an interest in it. I work from the controversy side, and I bill my clients enough for the mistakes that they've made in the past, and I don't really want to do that. Well, I do. Everyone will always have problems, so it'll be fine. So, okay, I've taken enough time. That's all I have. So I'm going to kick it back to Nicole to get back to
Thanks so
our
much.
non-tax
Everyone likes to talk about tax.
Yes, they do.
They do. It's one of the key pieces. So, All right, so next, getting back to just overall corporate structure and kind of the key pieces that make up your decision on what you want to do. Next, we're talking about ownership. So first we're talking about the LLC ownership. So an LLC is owned by its members, which is kind of another way of just saying people that come in, that have invested capital, that are part of the business, they actually own the company. And so the allocation of ownership and initial contributions are specified in the operating agreement, as everything is. You say, you have your operating agreement, and in there you say, Susie has 50% of the ownership of the entity. She put in $50. X person has, another 50%, they put in $50. So you put all of that in the operating agreement, both to keep it straight and because it is the governing document. And so if something happens and you all disagree and it goes to court, then you come in and say, well, they do own 50%, so they're entitled to 50% of the company's profits, they're entitled to 50% of the company's, at dissolution, etc. And so profits and losses, that's kind of a tax issue. They do not have to be divided equally among members. You can set all of that out in the operating agreement. At dissolution, the remaining equity goes to its members. And so, the bakery shop's done, you found a buyer that wants to buy it. Those profits will be distributed based on how you laid it out in the operating agreement. So 50% to X, 50% to Y, or however you want to set it up. So a corporation, on the other hand, it's owned by shareholders. And so similarly, people invest in the company, they get a portion of the ownership of the company. Corporation has to issue shares, and you can issue dividends to shareholders, but you can also withhold them. And so dividends are, if the company makes, $100,000 that year, they can say, we're going to take $20,000 and distribute it to our shareholders and keep $80,000 just in the company, use it, invest it, for next year. And so that $20,000 though, corporation makes the decision and says, we're going to, send it out, everybody gets $10. Shareholders are entitled to equity liquidation, similar to LLCs. And so, say you found a buyer, once again, you'll be entitled, you have 10 shares of the corporation, and there's 100 shares total, you get 10% of the profits of the company at liquidation. Yeah, absolutely.
I guess dealing with corporations and definitely on the community level, and often corporations can get a bad name because they can be so bloodthirsty. I guess the education, often corporations have a fiduciary duty to their shareholders, and basically bloodthirsty, so they have to basically make money for the shareholders. And so oftentimes they have to avoid being compassionate to the community because they have a fiduciary duty to their shareholders.
That's true. That's starting to change a little bit. There's there's B corporations. Yeah, B corporations are becoming more popular, and that kind of lessens those fiduciary duties a little bit. And says you can, try to be eco-friendly. You can try to, invest in the community. But once again, that's obviously not the majority of corporations. The majority of them are out there just trying to make money. That is their only goal in life, is to make money for their shareholders. Which, if you're a shareholder of the company, then that's what you want them to do. So, yeah, thank you, Robin. Feel free to jump in, whatever.
We do have one more question.
Yeah,
in the chat.
absolutely.
It says, can members of the LLC receive a salary?
Members of the LLC, so they can't receive a salary as a member of the LLC, but you can be employed by the LLC separately. So if the LLC wants to appoint a CEO, then you can be employed by the LLC, and the LLC can pay you. But you have to set up, separately your employment tax situation. You need to register with the Kentucky, Labor Department of Revenue, Labor, yeah. So whatever. So yes, you can have an LLC can have employees, but you wouldn't be employed as a member, but you can both be a member and separately be an employee.
The LLC will pay that member.
Yes. So the money would be, whatever's in the LLC wouldn't be, the person paying themselves. Yeah. If you have money that's actually in the LLC, even if you have a bunch of members, so you have 10 members, they all put money in. You add that money in the LLC is paying the salary of the one person who's employed. Yeah, definitely.
And I guess
Yeah, absolutely.
definitely, I'm talking really encourage me to actually kind of set themselves up for salary and really to help them manage their personal finances as well, to make sure they're actually their businesses make enough that they can meet their personal needs. And if by protecting that salary, they can kind of determine how that goal, how what was they to operate to really maintain themselves personally.
So next, we're going to just briefly go over management. So an LLC management is, you can either be member managed or manager managed. So those are the two options. Once again, you put that in your operating agreement, it's also in your articles, and you say, I'm going to be, managed by every person in the LLC itself. So if you have 10 members, then every member equally shares in the right to make decisions. They all share in the management, they share in every decision. Whereas manager managed, you can say, those 10 members can say, we're going to appoint one of us or some other person and say, this person is the person who's actually going to run the day-to-day operations of the business. Each of the members owns 10%, but they're not going to have any decision-making control. Or if you're an LLC, once again, it's super flexible. And so you can say, we want, the manager to run most of the day-to-day stuff, but if they're going to try to sell, 10% of the business or more, then the members have to vote on it. So you can, put limits on the authority that the manager has, but, you can have them, if the people don't really want to be involved, if they mostly just want to be, contributing capital to the entity, they can do that and have someone else be running the business. Whereas member managed is best if you are, every person is an equal partner, you're all going to be making decisions, you're all going to be, coming together. We recently had somebody set up a salon, and there were 5 people, they were all going to be running the salon, they were all going to be working in the salon, it's all going to be equal. So they decided to go with member managed. It is sometimes a little bit easier to go with manager managed, just because you know exactly who's in control, you avoid some of those, issues, and then put limits as you see fit on the management. You can also have a board of managers if you want to do, not just have one manager, you can have, say, 3 people. Say these people, it's kind of like a board of directors, but for an LLC, and they are the ones who have like the control over the business decisions. And yeah, I think that's it. Manager can be a member, but doesn't have to be. Generally designated by vote of members. Yeah, so the managers, would be appointed by the members, similar to a board of directors of the shareholders. And so next is the management of a corporation. So corporation, as we just discussed, is managed by the board of directors, and those are elected by the shareholders. So the shareholders do still have some authority over the business, and that they're the ones who elect people who actually run the business. They can't just elect themselves. So everybody has a say in who they're appointing. And the board is the one who actually decides who's going to be the CFO, who's going to be the CEO, who's going to be, in charge of the day-to-day operations. So normally what we see is a board is they're not the ones running the day-to-day operations. A lot of times in an LLC, like the managers are the ones running the day-to-day operations. Sometimes they appoint officers, sometimes they don't, just depending on what works best for them. But with a corporation, normally the board is meeting, say, once a month, once a quarter, depending on how hands-on they want to be. And they're saying, kind of looking at the financials, looking at everything, saying, where's the business going? What do we need? Do we need to hire another employee? Do we need to change the CEO? Is he screwing it all up? Like, what do we want to do? And so that's their role. And then the actual day-to-day, entering into contracts, managing the business relationships, that's all done at the officer level. So the CEO, CFO, etc.
Question.
Yes.
Is there a law or regulation that determines how often the board must meet?
I don't think so. There may be an outer threshold we have to meet at least once a year, but we would really recommend that if you do have a board of directors, they're meeting at least once a quarter, if not once a month. A lot of times we see once a month, or but a lot of times it is once a quarter at the minimum.
I have an actual question,
Yeah,
not a stage question. I run into a lot of clients who do have a corporate form, whether it's S corp or C corp, and I heard you say, well, shareholders can't just elect themselves as a director, but that is in fact what happens.
You mean directors can elect themselves?
Yeah, shareholders cannot elect themselves.
Oh, I'm sorry. I meant the board of directors cannot elect themselves. Shareholders like. the board.
Gotcha,
Yeah.
gotcha. Well, and that I think leads to just a short comment, which is in a lot of corporate settings, we're not dealing with like Twitter. That's Elon Musk, that's what's on the line. We're dealing with small organizations with a limited amount of people. And we've talked about like shareholders, directors, employees, members, managers, and a whole bunch of other terms. And these are just sort of like different hats you can wear, right? So I have my shareholder hat or owner hat that receives my interest in the company. I have my director or manager hat that sets the oversight of the company. My officer hat that does the day-to-day, or the employee hat that does the day-to-day. And you can be wearing all three hats at the same time, right? So it's not that you have to have like all these people to do this.
Yes, that's true. Yeah, you definitely don't need like a team of, 5 directors plus 3 officers
Yeah.
plus, ex-employees to have a fully functioning run business. A lot of times you see the chairman of the board is also the CEO,
Right.
and it's also, very common. So, yeah, it's a good point, Patrick. Thank you. So where was I? Shareholders have a direct say only in major decisions. So unlike with the LLC, where you're setting out very flexible, you're setting out exactly what the shareholders have a right to, or the members in that case have a right to vote on, saying you can't sell part of the business without us consenting, you can't enter into a contract for 5% or more of the assets. But the corporation is a little bit different, and shareholders do not have a direct say unless there's major decisions. You can put some stuff in the bylaws, but it's a general rule. Like the board of directors has the authority to run the business, and the shareholder is not coming in on every decision and saying, wait, you don't think that's a good idea. Like they're just passive investors. The board's making the decisions. There are certain things, like for example, if there's a merger, if the board of directors says we want to merge, the shareholders have a right to vote on that, and they have a right to dissent and say, we don't think it's getting fair value. And then, you go to court, and the court says, we think we're worth $5 a share or whatever. But which actually just came up in one of our companies. But yeah, it is a general rule. They're much less involved. You're passive. You're not intricately involved in the day-to-day operations, unless, as I said, you're also a member of the board or a officer as well as a shareholder.
And depending on what type of shareholder you are, you may not have voting rights.
That's true. Yes. Yeah, that's very common. If you have multiple classes, a lot of times you have like class A and class B, and so you have class B non-voting, class A voting. There are still a few things that class B shares, if you're non-voting, are statutorily forced to vote on, they're forced to allow you to vote on, but as a general rule, you don't have voting rights on anything. So, on to funding options. So there's a few different local financial aid programs. There's also some national ones, but a few local ones that jumped out to us and we worked with a little bit is Access Ventures. You all may have relationships with some of these, so you may be able to speak more to that, Donovan. But Access Ventures is a Louisville-based group investing in minority, women, and disadvantaged businesses. And from what we understand, they're pretty good about working with you, and they're very, very open. But once again, they do have like pretty hard limits. And do they have a, if they have a cap? You have to reach a certain threshold
I think
to
a lot of the programs are income-based.
income-based. That's what I thought. Yeah. Okay. And then Metco Loans, the Metro Business Development Corporation, administers small business loans under the supervision of the Louisville Metro government. So if you want to, a lot of times they're very like interest rate advantageous. So they charge very little interest, or they have like different things to make them preferential to just going to PNC and taking out a loan for your business.
They also are looking to offer Sharia type loans
Okay.
as well. Through the
Great.
familiar with Sharia type loans are long way with no or very low interest rate.
Here's what you
It's
should
kind of
about
like the
business
person-
government. Okay. So you
It's
make-
almost like a venture capital. The person who actually sit on the money, you actually have some kind of ownership in the business until they fail.
You got it.
Do you have anything to add?
No, I mean, that's pretty much it. Given
What you call
Sharia.
Sharia.
that? How you spell that?
SHIR.
SHARI.
Yeah, I know. So my colleague Brenda Hyatt is actually the next one on me. But, so they're adding that, and also it's based on like a specific religion, certain religion based, so. I didn't know.
Since it's still a city, I'm not looking at it. Has to be spread out beyond religion.
Yeah.
Yes, yes.
That would definitely be tough. Do you have any recommendations for like how to actually reach out and see if anybody qualifies, see if you qualify for any of those loans that are available?
So, yeah, so with the Metco loan, it's just different, like there's different, loans that you can do, there's different, you don't have to have collateral for some different loans. But as far as the Sharia, that hasn't happened yet, they're still talking to the board about all that, and that's my colleague, but I can get some information out to you.
Yeah, that might be
I
good.
can have it.
Circulate it with the.
I can definitely.
Perfect, thanks. And then Center for Entrepreneurship, created by the Urban League, offers financial literacy programs and free financial services. So like we said before, there are, obviously accountants and lawyers are very expensive, but there are certain organizations around town and nationally that will provide some of the services for free. For example, we're looking to help you guys, if anybody needs some formation services, just basic, articles of incorporation or articles of organization, if you're a LLC, and a basic operating agreement, looking to help you guys out. We have a pro bono program that we're starting up in connection with us to help you all get those basic documents done for free. And so other funding options, Sba loans, if you don't qualify for some of these slightly more advantageous loans for certain groups or for certain income levels, Sba loans, small business loan, partially guaranteed by the government, or, if you don't have any other options, then you can go with a personally guaranteed loans. You can just go to PNC and say, I want to start a business. I will put my home or my assets on the line to take out this business. I really believe in it, but we would not recommend doing that unless you have to, obviously, because you're opening yourself up to a lot more risk. And then another one that we see very, very frequently are individual investors. And so acquaintances, friends, family, people who believe in your work, seek shared success. So a lot of times the best way to fund your business is to, incorporate, which we always recommend, form an entity, a formal business, and then bring on shareholders or bring on members and get them, a percentage of the business in exchange for capital. If you still want to be the one in charge of the business, as we said, you can be have a manager manage, you're the manager, and then people are coming on just as passive investors, they're members, they don't have any say in the business, but they are entitled to a share of the profits, or they're entitled to the assets on liquidation, but they are getting a piece of your business, in exchange for actually giving you the capital to start that business up. And there's a lot of different ways you can structure that relationship, but that is often the best way to just get off your feet. Obviously, there's not interest associated with that, so it is a good option, assuming you have people that you trust, people that you want to work well with.
Another good thing to do this year is L-Home. L-Home is another entity that offers some small business loans. That's a great thing to require. And dealing with funding options again, probably ties back to taxation, the importance of having an accountant, because oftentimes if you're going for these different funding options, you're going to have oftentimes at least 3 years of your tax returns to be in. And typically, if you need with us at least your balance sheet and profit and loss statements for those 3 years. Oftentimes, they not very much often ask for a cash flow statement. But then, and we must know that a lot of our businesses have to know that a lot of them have their taxes done by tax preparers, and tax preparers are not accountants. And so,
Thank you.
right, and so we not be a good person for a lot of your financial consultation. It would not be very good to go to your tax preparer for that, and as well as for creating your financial documents outside of tax forms. Many of our tax preparers are not really qualified to create sound financial documents as well. And so that's when you may need to reach out to an accountant, actually accounting, and reach out to your community resources. I think many of our local incubators offer assistance with professional services. I know we here at the Clan Room, we offer assistance with professional services. So many of our clients may need an accountant or an attorney or an IT guy. We have a team of professional service providers that we work with that we provide assistance for, that we may provide self-management assistance for the obtaining those services based on the health of your business.
I think that's it for the financial aid options. Just a very brief overview of kind of the pros and cons and why you would choose certain entities over others. So investors, especially venture capitalists, prefer Delaware corporations, as we discussed a little bit earlier, but that part may have been on mute, so I don't know. Over LCs, so generally investors are more familiar with Delaware law, so they're more comfortable. They know what's going to happen if a dispute comes up because they have all this case law going back, however many years, saying this is what's going to happen. So there's that consistency, and they're comfortable. It's also more consistent on managerial duties and obligations, and so they don't, not to hate on Kentucky law, but they do change their code a little bit more sometimes in Delaware. Like the states, other than Delaware, they're a little bit more changeable. They're kind of tweaking things, whereas Delaware is very consistent. And if they do make a change, they have a lot, they release a lot of guidance on it, and you know exactly what's going on. It's also preferred legal form for business-related dispute resolution for those same reasons. You generally can guess what's going to happen if something does go to dispute. And so investors, whenever they're going in saying, do I want to invest in this company, will say, I would prefer to invest in this one because I know that something comes up, like I'm going to be able to predict it and I'm not opening myself up to more risk. And then investors generally dislike S corporations because S corporations, while they're similar to corporations, that preferential tax treatment does come with a few caveats, such as you can't have different classes of stock. You also can't have companies as a shareholder, and you can't have foreign owners. You can't have preferred stock. So a lot of times, if you're coming on as an investor, and you're saying into an already existing business, you're saying, okay, I will give you $1 million, but you want to make sure that you are getting your money back before the people that are already in the business. Because if you're taking on a little bit more risk, they're already involved, you want a little bit of preferential treatment, and so that you will get what's called preferred stock. And that can come with a host of different preferential rights, one of which commonly is you get to be paid out if the company dissolves sooner than the people that are already in the business, the people that came on, the friends and family, that started the business initially. If you're more of a corporate investor, you want to make sure that you get your money out. So if you're an S corporation, that is not an option. And so that definitely makes it less advantageous to bring on some of those more, corporate investors. That's LLCs similarly. I don't know if we have a pretty good LLC slide. I'm not seeing it here, but in general, LLCs, we really recommend if you are not looking to, if you're not in tech, you're not looking to like massively grow your company, you're not looking to be like I said, the next Elon Musk, you're just looking to operate your business, kind of start out, grow it at a moderate rate, go through some of the other funding options such as loans or friends and family. It works really well for that. It's very flexible. You can, make it however you want it to be. You can give people certain rights. You can give people, different voting options. It's just a very easy, simple format. You just have to file an annual report. It's very straightforward. The formalities are not as rigorous that you have to go through. It's definitely the best option if you aren't looking to kind of go that high growth route. Do you have any other comments on which entity you would recommend?
It depends. Just
That's the thing. Yeah, it really does.
depends. Talk to someone, talk to professionals, accountants and attorneys who have done this before.
Everyone's circumstances.
And it's depends on the size of the business.
Yeah.
Yes.
One thing I want to go back to taxation, definitely know for a small business and definitely get with accounting and not a tax preparer. Because oftentimes we have a tendency to operate our business at very low profit, where the loss to avoid taxes, that oftentimes puts us in a bad financial position because we ever want to get any financial funding. then their business doesn't look like it's very profitable or healthy. And so therefore that doesn't make you attractive for you to invest or to loan money to your business. So oftentimes it's good to pay, you have to pay, to be in business, you have to make a profit and pay more taxes, to sustain and grow.
Yeah, like in the electrical industry right now, there's more projects than there are electricians. And people are borrowing electricians from one company, borrowing electricians from another company to do a project. And, they're doing things like that, and they're loaning, then there's a joint venture. What's the structure on a joint venture?
So we're actually,
Well, you also got subcontractors, contractors, got the subcontractors. You got general contractors coming, contractors, got the subcontractors, and you got subcontractors coming. So,
yes, so we're actually gonna have one of our partners come in and talk about joint ventures in one of our next meetings. This is just kind of more from somebody who actually worked in the construction industry and has a lot more knowledge on how all those relationships work. Just to give an overview, like a contract overview, and then, joint ventures and what kind of pitfalls to avoid and things to make sure that you're doing. Yes, that's gonna be one of maybe the next class that we go through.
Yeah, and then what's really happening, you see that more and more in the construction industry right now. Really, that's kind of also filled by the kind of the meeting or the drive to have more minority and small businesses in construction. And oftentimes, what is key is eventually joining the smaller businesses from this larger business because they lack the capacity, and hoping they will learn and able to build that capacity through that joint venture. So they may go on and they will land contracts on their own. But it's oftentimes like you, as a small business, you're not large enough to even apply and land on these contracts. In order for you to participate, it's often having to do joint venture with a larger firm to make that deal more attractive.
And if anybody has any, specific areas they'd like us to talk about, we have, people in our firm that do a ton of different things. I am just starting out, and so, I do mostly public company work, which doesn't necessarily apply to everybody. And so my knowledge, like the actual corporate, basics and the basics, but there's some people who really specialize in like private equity, people who specialize in venture capital. We'd be happy to have them come in and get into any, nitty-gritty details of any specific areas. So maybe just talk to Donovan if you all have any specific areas that you'd like us to cover. I think we're going to try to do one every couple months or so. And I think the next one is going to be on, joint ventures, because that seems to be a pretty hot topic for people.
So it's very hot. It's very hot.
Yeah.
It's construction industry. That's it. I will thank you.
Yeah, and if anybody needs help with formation, just reach out to Donovan, and we're happy to help. We have, pro bono program, and so we're happy to assist depending on like income limits. We have certain criteria that people have to meet in order for us to like use those pro bono hours. But we do have basic formation documents, and we'd be happy to get things going. We'll also have some lovely summer associates to prepare some forms. So they've done great work. So
Also, we put you guys to work. All right, thank you guys. Thank everyone for coming out. Nice to meet you.
yeah, thank you so much.